Welcome to Market Monday from the investment team in the trust department at the First National Bank. We're going to do things a little bit differently today than we typically do. And we're going to begin talking about energy prices and the current geopolitical situation going on in the Persian Gulf. So, over the weekend, we had some new exacerbations of conflict, and actually late last week as well, where the Iranians came out and attacked a ship, and we in the United States hit them back by attacking some of their facilities. Then they've done it again over the weekend, and we've hit them again. That actually sounds like pretty much active fighting if you look at what the fact pattern is, particularly in light of another fact, and that is this so-called Memorandum of Understanding really has no clarity at all to it. It certainly doesn't accomplish the stated goals that we went in there with. In other words, depriving Iran of all their nuclear material, taking control of it, and preventing them from getting weapons and of that nature, and control of or at least free passage for international trade over the Strait of Hormuz without Iranian tolls. And neither of those issues is addressed. Instead, it extends a so-called peace for negotiations on these topics, which we're pretty convinced here are just going to result in more of the same that's happened time and time again with the Iranians, and that is they'll use the time to rearm and continue to provoke and not really get anywhere. And so does that memorandum of understanding really constitute a durable peace? We don't think so. In fact, we don't even think it shows any sign of a peace at all. When you've got two sides shooting at one another, that's a strong argument that the war persists, regardless of whatever's being said. Now, we're not predicting a return to open warfare, at least barring some new crisis that develops. However, the most likely situation is not peace in this situation as things continue to unfold, but more likely a stalemate where we continue to extend time and talk. The Iranians continue to rearm and provoke. We fight. We send some missiles their way. They send some ours. And it's just status quo of a low smoldering conflict. The problem with that is it's uncertainty, and the markets don't like uncertainty. So Oman, I believe, came out over the weekend or late last week and said that Persian Gulf shipping through the Strait of Hormuz will, quote unquote, never be the same. And when you have that reality that the Iranians are going to continue to do whatever they can to hassle their neighbors and extract tolls, on shipping through that region, and attack ships that so-called violate their principle, they are in effect raising uncertainty, and uncertainty is going to be baked into premiums for shipping insurance, and it's going to be baked into inadvertently or down the line into the price of oil. So we're viewing this pullback from the recent rise up to about 120 in Brent crude as temporary and subject to a lot of volatility. And, with the higher energy prices that are already prevalent relative to the more recent past, we have supply chains that are being squeezed. It's not just energy prices. Inflation in general appears to be borderline out of control, even by the Federal Reserve's own metric, the core personal consumption expenditure indicator. And as a result, corporate balance sheets are going to maybe encounter some issues with their continued growth, and certainly the income statements are going to be suffering from pressured margins because input costs are going up, and there's a limit to what consumers are going to be able to absorb and continue spending. So far, we haven't reached that point yet. Spending appears robust, but when we do, companies will begin selling less widgets, and they're also going to be doing it on a smaller margin because producer prices have been going up by a good bit more, or at least a good bit more rapidly than consumer prices have, which means by definition, corporate margins have to be shrinking. So they have to sell more units in order to deliver those profits. And all of this factors into potential volatility in the equity markets. So we're going to come back to that in just a little bit. That was laying a framework. What's happening over the next couple of weeks? Not much. I mean, we've got the 4th of July holiday. This week and next are expected to be lightly staffed on trading desks. That means that any of these economic reports or headlines related to the war over there including between Israel and Lebanon as well, could move the market in an exaggerated manner because there aren't as many traders at their desks to take the other side of trades, and that liquidity tends to slow down market moves. So we might see amplified market moves if a headline comes out, but these numbers are relatively tame in comparison with the news headlines related to the war. We get the Purchasing Managers Index, the Consumer Confidence Number. Those are important. They're outlook, numbers. We get some information about manufacturing, and this is probably the biggest one over the period outside of the Fed's meeting minutes getting released later on in the next couple of weeks. But the change in non-farm payrolls is typically the main event for the month in terms of economic reports, headlining, the health of the labor market. And when we see a forecast for 113,000 jobs created, relatively in line with norms across historical expectations and historical results. So when we see that number, we're not thinking, oh, wow, the labor market's in trouble, which is what you'd have to be thinking if you were wanting to cut interest rates. The change in payrolls at different, more granular levels, that's fine. We're not really as interested in that as the headline. The unemployment rate's another somewhat big one. It's tied to the other non-farm payroll number, and that's expected to come in at 4.3%. And that number is substantially below the 5% level of quote-unquote full employment that the Federal Reserve uses, or not the Federal Reserve, the more like just the general economics paradigm uses as full employment in the economy. So when you have a number lower than 5%, that suggests that the economy is actually running kind of hot with respect to the labor market. And we'd say at that point, these things argue that the labor market is at least an average health, let alone it might be a little bit healthy. It might be robust. And that does not argue for rate cutting. That argues potentially for rate hiking, particularly when you look at the recent inflation numbers that have come in hot to the point that suggests that inflation is either already out of control or beginning to get there. And the Fed is more likely to have to raise rates under those conditions. We get durable goods orders and, more sentiment information. The meeting minutes from the FOMC are consequential because under the new chair, Kevin Warsh, they have made substantial changes to the forecasting that they do, or at least the communications with the markets that they do. It was said that they're going to stop giving a dot plot, which is essentially an idea of where all of the Federal Reserve officials, voting members on that committee, see interest rates over a period of, the finishing up of this year, 1 full year, 2 full year, or 3 full years, and then further. And when we see, communication being reduced, more opacity being introduced into the Fed's, information gathering, deliberations, and views, that can only increase uncertainty. We don't think this is a great idea because markets don't like uncertainty. So that's going to make interest rates more volatile. That's going to make equity prices more volatile. And that's just a simple function of increasing uncertainty from what the central bank is likely to do because they've reduced their communication, and market participants now have to take trades and account for risks that were less risky from the sense of having more information under the old regime, where they would forecast and they would telegraph what their thinking was through the dot plot and various other forms of what they called forward guidance, which they're curtailing now. So how things are in that meeting minutes and what they precisely discussed relative to that issue is something that a lot of market participants are going to be keenly observing or looking for if they're going to provide it, because again, they don't want to seem to be as communicative as they have been in the past. Again, lastly, information about the labor market and the real estate market. So coming back over to this issue in the Persian Gulf being the main headline risk driver over the next couple of weeks, and the fact that we expect energy prices in general to remain volatile, and those energy prices have been freezing out chip makers. So last week, Apple, Microsoft, and other other companies that are involved in the technology space, heavily reliant on microchips, have raised their prices. And there's really no end in sight. A lot of the other elements that are involved in making microchips beyond the energy requirements for the plants to do it include some rare or at least more difficult to obtain materials. And then there's helium, which is something that's deeply involved in the chip making process that's been also in shorter supply. So the chip makers are struggling, and that shortage of chips is a direct consequence of this issue in Hormuz not getting better. Remember, our forecast is for status quo being the state for the foreseeable future. So we're going to continue to see all this uncertainty and volatility and potentially constrained shipping through that Strait of Hormuz, potentially continuing to choke chip makers and cause technology costs to spike. And as that's happening, that's not great, because in the S&P 500, technology is nearly 40% and over 40% by some metrics technology. So that's been the thing leading this whole bull market, that we've had this year from the spring. And potentially this could be a catalyst if this shortage in chips continues and prices get raised to unpalatable levels for consumers. We could really see another ingredient for a potential sell-off. So this toppy type pattern could be consolidation and the market just going sideways for a while. It could be a prelude to some sort of a decline correction in the fall, which would not be unlikely given the run-up that we've had and given all of the potential catalysts for volatility that we have out on the table, and the time of year being the most statistically likely period of the year in September and October for those type of events. There's a confluence of factors here that bears watching. If the volatility comes, again, we're going to take the longer view and say, well, you have scary times at various points where markets are going down, but you stay true to your long-term investment plan, and you just kind of make sure that you don't make emotional decisions and sell into something like this or buy into something, exuberantly into a bubble. You just take a disciplined approach. So we're going to continue to advise that for clients. But this chart's meaningful from the standpoint of keeping those expectations in line. So if we see a decline here, this is a logarithmic chart so that it shows the magnitude of each move percent-wise as a function of this chart as well, so that you can kind of see which events were more consequential. In this event, this was 2020 when everything closed and we thought the world was going to end. And this was the crisis in 2008 and 9, which was far greater in magnitude on this chart. But if you look at it on a line chart, a regular one that's not logarithmically oriented, that 2008 looks like a blip. And the reason it looks like a blip is, it's so far back, price being lower. If you don't change the distance of the chart to account for the magnitude, it obscures how sharp those moves really were. Whereas this lets you see, okay, this 2008 crisis was really something compared to even 2020. And most of these other things are just relative non-events. And, we're not seeing anything like this on the horizon. And this stuff is just kind of par for the course. You take risk when you buy stocks, but not everyone needs to be in stocks all the time. We have great rates right now across corporate bonds. 5 years is 4.66 average on A-rated paper, and you're over 5% at 10 years. And if you go to 30 years, you're getting 5.7, which is, that's pretty close to 6. And that's for an asset class that reduces volatility in your portfolio. So, a few years ago, they were bandying about this idea of the so-called 60-40 portfolio, in other words, 60% stock and 60% bonds, as being quote-unquote dead. Not so much anymore. Investors are now getting paid 4, 5, 6% to essentially reduce risk in their portfolio and generate income with a portion of it. That way, the overall volatility of their experience is not even that of the indexes. So it's a decent environment, even if there is volatility, and volatility does mean opportunity. Going into the Treasury curve, this is worth watching because rates kind of indicate inflation expectations. And so we think that there are people that are positioned incorrectly on the assumption that this memorandum of understanding is going to hold when in fact all of the evidence, the actual actions that are going on, not the words being spoken, indicate that we're still technically at war with Iran and that it's likely to indefinitely last. This was this was rates a week ago, slightly higher. As you come down, and when you're out on the curve, say past 5 years, even 2 years, really, you're getting inflation expectations as the real driver of what the rate is. That's the main pricing factor in the rates model for the United States Treasury. And so when we see them having come down 8 to 15 basis points, depending on where you're at on the curve, that suggests that potentially investors are seeing a little bit of reduction in their inflation expectations, but we don't see how that makes sense given the numbers on the PCE that came out last week, which indicate that inflation is much higher than what the Federal Reserve's official comfort level is, and increasing as well at the same time. So, the fact that rates have come down on this, and AKA, inflation expectations have come down on this memorandum of understanding, the evidence that it's not holding and it's not what it's purported to be suggests that a lot of this buying might have been premature. And that could lead to higher rates down the line as people get caught off sides and large investors get caught off sides and have to sell positions at a loss. So we're watching that as well, particularly in the holiday week. Headline risk could drive that. So if conflict gets renewed in any sort of fashion, if oil fields get hit with missiles, that's likely to cause a spike in rates, which would cause a decline in the value of bonds. And that spike in rates could also, move over into the markets and cause volatility. So we're watching all those factors. But again, let's close with this. The market climbs a wall of worry and falls down the slope of hope. And there's a ton to be worried about. There's a bubble. There are multiple wars. There's inflation. There's, rising delinquencies on credit cards. There's all sorts of things to be worried about. And the market, for the most part, continues to go up or at least tread water at its all-time highs or near its all-time highs. So we're just going to be here observing, and hopefully you found the video useful. If you've got questions about the implications of any of this stuff for your portfolio or your investment strategy, feel free to give us a call. And thanks, and have a great day.